Ladies and gentlemen, welcome to the Frame of Mind Inc. podcast. This is your boy Simbawi Nibaye Jr., aka TK, along with my man Omar Williams. We call him O. Say what's up to the peeps.
What's going on, good people?
Another lovely Wednesday, and y'all know how we do. We jump right in and get things started right away. But before we do that, it is Affirmation Wednesday, and y'all know we do affirmations every Wednesday, whether it's 7 a.m. or 7 p.m. And so if y'all are ready for the Affirmation Wednesday, or if you're getting the replay of this, whether it's via video or audio, it can be affirmation, whatever day it is. So here we go. Affirmations for the day. Today will be a good day. Today will be a great day. Today will be an awesome day. Today will be an amazing day. Today will be a phenomenal day. Today will be stress-free. Today will be a stress-less day. Today I will overcome all barriers that want to block my progress. Today all circumstances, issues, and situations will line and work up in my favor. Today all things will line up for my good. Today I will become better than who and what I was yesterday. I am a go-getter. I am victorious. I am triumphant. I am an overcomer. I never lose. I either win or I learn. I take authority over this day. I will dominate this day. I will conquer this day. And everything I have spoken into this day will happen as I have affirmed, because I am more than a conqueror. Let's get it going. So today is stock, trade, and investment podcast with my man O. So y'all, as know as we do, I'm gonna step aside and allow O to do his thing, and we're gonna jump right in and get this thing started bright and early. O, the floor is yours, my friend.
I was on mute. Again, like to say thank you, good brother, for the opportunity to be able to share this information. So let me share my screen, and then you can move me over. Let's see, share screen. Share screen. I gotta hit something.
Let me see here, brother. Let me get
Yeah,
you.
what I gotta do, brother, man?
Let me see. You should be able to do it on your end.
I hit it. Share system audio.
Hold on, let me do this real quick.
All right.
There we go. Got you.
We good now?
Hold on. I got you, brother. Intermittent. Small technical difficulties, people. That's all. I didn't hit the right settings here to let my man O share his screen.
Should I cancel out?
I'll
cancel out, and then screen sharing was canceled. Okay.
Yeah. And I'll go ahead and get you going here real quick. Hold on a second, good people. As my man O says, good people.
Yes, sir. Well, while my man, I can get started while my man's doing that. So tonight we're gonna pretty much talk about well, first I'm gonna give you 8 ways to profit in a bear market. A bear market means the market's going down. And the reason they say it's a bear market, because a bear attacks down, and you heard of a bull market because a bull attacks up. I'm able to share now.
No, keep talking. I got you.
Oh, okay.
So I got you.
So tonight we're going to talk about, again, 8 ways to profit in a bear market, which means the market is going down. And again, we got all this. The Fed is talking right now. You got this inflation fears. You got COVID fears. You got a lot of things going on that can actually affect the market for the worse. So we'll get started with the first thing. The first thing to do to profit in a bear market is first find a good stock to buy. Now, the last time I was on here, I actually, the show was about how to find a good stock to buy. So I'm not going to go over in detail what I talked about, but I'll give the list of the things that you need to do for finding a good stock to buy. A stock that has rising profits, rising sales, low liabilities, a stock at a bargain price, the dividends are growing, the market is growing, there's high barrier to entry, a low political profile, an optionable stock, or a stock that's rising on a megatrend. Again, I'm not going to go into detail. Look at the last stock show we did, and it's detailed each and every point. But so that's the first thing you do in a bear market. So what happens is when you find a good stock to buy, some stocks get affected by the market itself. So not that the company's bad, not that anything changed, not that the sales changed, not that the profits changed, not that the dividends changed, but the market's going down. So you might get a company that's $100 that's worth every penny, if not more, go down to $75. That's a deal. Okay. Number two, you want to hunt for dividends. Like I just said, companies that lose in stock price. So this is what you're hunting for. Hunting for dividends is in a bear market. Keep that in mind. When a company loses its in stock price, the dividend stays the same. So if the dividend paid out $2.50 a share at $50, if it goes down to $25 and it still pays out that same $2.50, that's a come up. That's a really good thing. So now you can buy twice as many shares and get the same dividend yield. Can't beat that at all. Number three, you want to rotate sectors. Okay, so different sectors perform better or worse in different times. Okay, so for example, stocks that people want do good in a good economy. So for example, stocks like automotive stocks such as Tesla, high tech stocks such as Apple or Facebook, like tech stocks, and like home improvement stocks such as Lowe's and Home Depot. These companies are wants. Like what I mean by wants, the things that these people sell are wants of people. It's not like they need it, right? People do home improvements when they got a little extra money. People buy cars when they got a little extra money. People like get in, the high tech stocks. Tech stocks, people get involved in them a little bit more when you have this money just, around. Okay. Now, in a bad market, people go into stuff like consumer staples. Consumer staples are the stuff we grew up on, like Kraft. They make food, right? Utility stocks, like food and beverage stocks like electric stocks, oil stocks, things of that nature do good in a bad market because that's stuff that we need. So just look at it that way. I'm trying to keep it as simple as possible. In good markets, people buy wants. In bad markets, people buy needs. So that means so that's sector rotation. So what happens is this sector's doing good now. Market goes in a bear market. Then what happens is another sector will start to come up, right? And you can ride them cycles. You can go up with a good market, get into a good sector. When that goes bad, get into another sector that goes good in a bear market. And you can do that and ride that wave up and down. Easier said than done though. Okay. We good, brother?
Yeah, let's take a quick pause for the cause. Go hit your share button again.
All right, I'm hitting my share
and then
button.
pick what it is you want to share.
All right, we go. Let's see.
And then we'll see if that works. That way we can get the people a
reason,
visual.
Man. Oh, okay. I'm ready now. Ready?
Okay.
We good.
Right.
It says so. I'm sharing now, right?
Yeah. So go to the screen. Go to the one you want to share.
I want to share this screen right here.
All right, I got you, brother. I got you. I'm gonna do this. I'm gonna not that. All right, you good. Go ahead. I got you. You good. I got you.
Good?
Yep. Yep, be good.
Okay, so where am I? Number 4. So okay, I'll just name the first 3 that I did. The first one was find a good stock to buy in a bear market. Hunt for dividends that never change in a bear market. Hunt for the sectors that rotate to good in a bear market. So, like I said, in a good market, people buy wants. In a bad market, people buy needs. Consumer staples are in the bad market. Utilities are in the bad market. Food and beverage stocks are in bad markets. Auto stocks are in good markets. High tech stocks are in good markets. Home improvement stocks are in good markets. Okay. Number 4. This is a little bit more advanced to do, but trust me, it's not that hard. You go short on a bad stock. So what happens is on a bear market, you find bad stocks and you short them. So what it is in bear markets, good stocks have a tough time, but bad stocks get beat up crazy. So what happened is in a good market, a bad stock may rise. Okay. In a bad market, a good stock may come down 10%. In a bad market, a bad stock may come down 50%. So if you find the bad stocks while we're in a good market, when it turns around, you already know which ones to get in to go the other way. Now, I'll tell you later on, I'll tell you how to short it. But a lot of us don't have the accounts to short the actual, like you need a lot of money to short the shares. Okay. But there's another way to short it, and we'll talk about it in a little bit. Another advantage you could take advantage of in a bear market is buying a call option. So a call option means you're looking for the price of that share or the stock to go up. Okay, and when you're buying so when you get an option contract, it represents 100 shares of a company. And if you buy a contract, let's say like a company is at $50 and you buy a $55 contract. Okay, first of all, if you bought 100 shares at $55, that's $5,500. With an options contract, depending on the time you get it, preferably 6 months to a year and a half, that options contract price won't cost you $5,500. It'll cost you like $800, $900. So you're taking less risk, but you could take advantage of the bear market beating up a good stock. And when it gets back good again, it turning up, and your options contract could be worth a lot of money. That's another way. So let me just, I don't know if I don't want to go too much over people's head. So what it is an option is, I'm saying I would like to have an option to buy this stock if it goes beyond my price. Okay. So if I buy it at 55, I buy the contract at $55, it goes up to $80. I now got an option to actually purchase the shares or buy that contract to receive the shares of that company at $55. If that makes any sense, which it should. So basically, you're buying a contract to either buy or sell the shares. Okay. And that's an options contract. So when a falling market, as we saw when this market crashed recently, it reached a certain level and it literally turned right back around. Companies like Tesla, companies like Apple, companies like Facebook, I mean, you named Microsoft, they were all going for cheap and they all ran up high. Okay. So with stocks like those, people were buying options contracts because they knew it was going to move right back up pretty fast. And the faster it goes, the more price or the more expensive the options contract will be, which is good because you bought it at a discount. Okay. Any questions so far?
Nah, I think we're good, brother.
Okay, we're good. Number 6. So kind of this is another strategy of an option. So I just told you to buy a call option. Okay. This number 6 strategy in a bear market is a great one, and I love it. It's called to write a covered call option. It's pretty much a way, and lack of a better way to explain it, it's a way to rent out your shares to the market. So let's take this $55 stock I was talking about earlier. Okay. So you actually own the shares, not the contract. You actually have 100 shares of this $55 stock. Okay. If the market's turning, which I said earlier, when the market turns and goes down, it pretty much takes all of the stocks with it. So what you can do is you can pick a price in the future and rent those shares out to the market, right? What you could say is, okay, I'll sell the contract for this price for this stock at $60. If so, what'll happen is you'll sell the option for somebody to buy your stock at 60. What happens is if it doesn't hit 60, you get to keep, and when the contract expires, you actually get to keep the money that they give you and still own your shares. So you're able to make money on the way down with the same shares that you own. Now, what happens is if the price of them shares go up above $60, you're obligated to give those shares up at $60. Even if it went to $100, you got to give them shares to the person you sold them to at 60. That's the only negative side to selling a call option, but or to writing a cover call. But the thing is, the good part is, again, it's for down markets. It's not for going up. It's that strategy is for going down. Okay. So again, just to recap that, it's almost like you're renting, you own the company, and you're saying, you know what? If this thing reaches $60, I'll give the person the shares. If it doesn't, I get to keep that rent and keep and still own my company, right? So it's a good way to make money when the market looks like it's turning over. Now, there's another strategy too. If it's going up, it's called buying puts or selling puts. I'm sorry, but you need a little bit more capital for that. So if you think the company's going to go up, you can actually sell puts against your company, your shares. But I'm not going to get into that. Okay. But this number 7 is we're going to write a put option. What that means is if you feel like a company is crashing down, again, when I talked about earlier about going short on bad stocks, if that stock is optionable and it's a bad stock and the market's going down, they get hit brutally, right? So you buy a put option, and that's saying I have the right to buy this stock at a certain price. But if it goes below it, my contract will increase in value, right? So if you buy a contract at 55, you buy a put option at $55 and you expect the stock to go down, if it goes down to $35, that contract has now gained $20 in value. Okay. So you do 20 times 100, and then you see how it goes. So like 20 times 100, what's that, $2,000? So you've gained an intrinsic value, $2,000 plus whatever time's left on that contract. I know I'm getting a little I'm getting a little deep, but that's how people make really, really quick money in options. And a lot of times you can take advantage of these things in these bear markets. And the last thing before we get to this chart is just be patient. Okay. The majority of us do not, we don't trade in and out every day. We buy and hold, right? So like if it's a bear market and it goes down, there's nothing to be afraid of if you're in it for the long haul, right? So like, again, if you've seen prior stock shows, I've told you, just accumulate shares. There's a way to catch it at a good price, or there's dollar cost averaging. Okay. The majority of us that are looking at this have 401ks. Okay. That's literally just putting a percentage of your money that you make every paycheck into the market. Okay. I advise you guys to look into your 401k and see what different funds that they offer, what things are aggressive, what's less aggressive, middle aggressive, or less, or the least aggressive. Or they have things in certain 401ks that's like literally a savings account. You're just putting it's not even really in the market. It's just putting money up for you, right? So we need to see how we can maneuver and change around some things. Some of us are young and need to be in more of an aggressive fund. Some of us are old and might maybe need to be in less aggressive. Okay. And now that brings me to my chart here. Okay. So if you just think about, if you're retiring in 10 to 20 years, it's no need to panic about a market that's crashing. Okay. It's that happens. It's actually opportunity if you know what you're looking for. And tonight I'm going to show you a little bit of a plan if you want to, like, so most 401ks, so it's a 401k plan that I put together for y'all tonight that you don't even have to let me see something real fast. You don't got to look at that every day. You just got to tune in. Hold on, what happened just now? Hold on. You don't have to look at it every day, but you got to tune in at least once a week, maybe once a month, just to kind of see how things are going. Okay. So here we go. And we'll start back. So first, before we get started, I'm going to start about 5 years back. I started 2016 in February. If you can see where my cursor is. Okay. So if anybody out there has a 401k, the first thing you want to do is look at the funds that your 401k plan provides. That's the first thing. Look at the aggressive funds, look at the middle aggressive, like the middle the less aggressive funds, and look at the least aggressive or the passive funds, right? The older you are, the least aggressive you need to be. The younger you are, the more aggressive you need to be. Now, what I'm about to show you, your age don't matter. So here we go. That's the first thing you do. Then you need to go on to Trading View. That's not a plug for the company, but that's the charting software that I use. You get a free account, and you get three free indicators before you have to pay. Okay, so tonight, if you get a Trading View account, okay, the instrument that you're going to trade, because this is pretty much what your 401k trades, is the SPY ETF, SPY. Okay, you want to type that in, SPY. Again, learn the software, learn how everything works, learn how it goes. But once you get there, you want to get to this chart here, and you want to type in the SPY. First thing you want to do is you want to go to the weekly chart. Okay, so this is the day. This is the 4 hour. Okay, I don't know what's going on. Let's see. Hold up. Okay, yeah. So this is the 4 hour. This is the day. And this is the weekly. And what I mean by the weekly is, hold on. What I mean by the weekly is each bar here represents 1 week of trading activity of the S&P 500. That's what that means. So by the time every bar gets painted after 1 week of trading. So at Friday at 5 o'clock, another bar is created. Okay. Next Monday starts another bar. Friday at 5 o'clock p.m., another bar is created. Next Monday, the next bar starts. Okay. So that's a weekly bar. So once we do all those things, we find you find your accounts, you find where you can put your money depending on what the market's doing. Okay. I suggest you, when the market's going down, you take it out, you put it in something less aggressive. When the market's going back up, you put it in something aggressive. I'll say the most aggressive after what I'm about to show you tonight. Okay. Again, I'm not a financial advisor. Do your own research. And yeah, here we go. I'm trying to think where we're gonna start from. Okay, what did I say? You get Trading View, sign up for a free account, get your charting software up here. Again, you want to know more, get the O package. Go reach me through, Frame of Mind Inc. podcast. Okay. Get your Trading View, get your charting software up. You want to type in the SPY. You want to do the weekly chart. Okay. Next thing you want to do, you see these 2 candlesticks here. You click that. There's bars, there's candles, there's hollow candles, there's lines, there's area There's baseline, then there's this Heiken Ashi, right? Pick the Heiken Ashi chart. What that does is the Heiken Ashi chart takes an average of the last 2 bars. So it's not exactly price, but it keeps the price from looking sporadic or volatile. It kind of smooths everything out for you, which makes it easier, especially if you're long-term investing like I'm about to show you tonight. I'll give you an example of a regular bar chart. This is a regular bar chart. Look at this chart here. See how it's all over, it's up, down, not really. I mean, it's going in one direction because it's the weekly chart, but it's not smooth looking, right? Once I pick the Heiken Ashi, smooths it out. I don't know if you saw that, but it smooths it out, okay? Then, once we get that Heiken Ashi, what we want to do is we want to go to this thing that says FX right here. It says indicators and strategies, okay? Click it, and then you want to type in GANN. You want to go to the first one, GAN, high, low. Again, we're not getting deep tonight, but I'm just giving you do your own research if you want to do it on your own, or you can contact me through Frame of Mind Inc. podcast. You want to get the GAN, high, low by this guy right here. KIVANCOZBILGIC. And it has 2,763 people who have this on their chart. Okay. Now we can get ready. So what we do is, like I told you, these are weekly bars. Okay. So let's start from January 16th. The first week of January 16th. So, okay, hold on, let me do this. So if you see here, when the bar crosses below this line, it turns red, and when it crosses above it, it turns blue. Can we see that? Let me do this to make it get a little bit more pop to it. Make it a little bit more bold. I don't think that worked. Hold on, let's see. Okay, here we go. So again, when you see it cross over, it gets blue. When you see it cross below, it gets red, right? So this is what we do. This is for your 401k plan. Again, I'm not a financial advisor, but it'll give you a little bit more peace, and you can catch all the big moves that happen in the market, especially for long term. Okay. And you can get out. You can assure yourself that you're out during a crash. Guaranteed. I'm guaranteeing that with this indicator. That's a bold statement. So this January 16th, first week of January 2016, the market was down. You would then have gotten out of your 401k and you would have changed your account around. So, like, again, do your homework, find out what funds are available. When you see this go below the red line or the line, when it closes below, you want to put it in a non-aggressive fund. That's up to you to find on your own. Okay. Now, some 401ks allow you to make changes every 30 days, which is fine. That's even great. That's great. We just want to be safe, and we want to protect our money. We don't want a 50%, 30%, 20% collapse happening, and we're about to retire, right? We don't want that to happen. Now, people like me, I'm 40. I got time. But if you're 55, 60, and you about to retire in a couple years, you at least want to see if the market is going crazy. A lot of us don't even take the time out to even look at what's going on. We just keep on investing, and that's fine to do. That's the greatest thing to do. But I'm giving you something that you could check once a week. Yeah, actually once a week. You could check it every Friday night or every Monday morning, however you want to do it, or every Sunday morning. You can look at it. So you would right here, you would go on something line aggressive. Okay. You would go. Now, when you see it go here, now right here, you wouldn't have missed much, because when it goes back above the blue line, it pretty much got back in where you left off at. Now you want to go to aggressive again. So let's just say it's at 200. It's back below the red line. It's up at 212, 211 right now. So you would have made a couple bucks. Not a couple, a lot, but I'm just doing this. Okay. It goes back up again. So it goes below in October. So think about that. You started the year off down. You got out less aggressive. You get back in March to your aggressive. Ride that up all the way to October. So think about it. That's not even active. You've waited what? March to October? It's a long time, right? October, you go least aggressive again. November, another long time. You go aggressive. Now from November, 217 is the number. We go all the way up to March of 18. So we go from November 17 to March of 18, and now we're up in full aggressive. This don't matter how old you are. At 260, right? We get out March 18th to a non-aggressive, least aggressive. Again, do your homework on your own 401k. You want to get back in it, you would have got back in June. Okay. So you would have got out in March 18, back in aggressive June 18th. So let me see, June 18th, 274. You would have got out at 277. You only made 3 points. That's fine. Again, we're being aggressive, but we're being safe at the same time, because we have this indicator letting us know when the market's turning over. Okay. We'd have got out in October 18th and less aggressive. Waited all the way to February 19th. So we're down another year, because we didn't know what was going on. This thing was falling. We got out at 277. We're loving it right now. Once the 240, your money's protected because you're in something less aggressive. You're still in it, but you're not aggressive, right? Goes back up February 19th. We get back in at 269. February 19th. Now, check this out. You already know what happened. I'm about to show you the COVID crash. So we got in at February 19th, 269. We were going to get less aggressive at 306. February 24th, 2020. I'm not making this up. I didn't make these lines up. I didn't draw these lines to make it fit right. No, this is the strategy. You would have got out at 304. You got in late. You would have got in at February 19th at 269. You would have got out in 2020 at 304, February 24th. Okay. And been less aggressive. And that market was crashing. You didn't know what was going on, right? But you would have felt comfortable because your money wasn't as risk. At risk than it was, right? Because you got out in February 24th. Now you waited until May of 2020 and got back in aggressive at 298. So think about that. That was even better. You got out at 304 and got back in aggressive at a lower price. So you took that 298 in May of 2020. Come on, man. Again, I gave y'all a gem. And you still riding it. You still out. It's up to 454. That's 200 and come on, man. That's 155 points. And you still would be in it to this day.
That's good
stuff. I don't know who's out there listening. I don't know who out here seen it.
That's good stuff.
Real. A brother. I mean, it ain't hard. So if you, like I said, if your wife got 401k, you got a 401k, just take this line again, replay it. Cause I know I was, if I wasn't that clear, just replay it. Look at what I did. And I gave you a freeway. Like nothing's going to cost you anything. TradingView is free. And you get 3 free indicators. I only gave you 1 indicator. You can even add 2 more if you want it. Well, look at that, man. It would have got you out the crash up here and got you back in down here, and you still be in it, man. So even if something happens crazy, like even if it crashes and goes to 400, we be out of it. We out. Not out of it, but we'll be less aggressive. That's all I'm saying. So there you have it.
There you have it.
There you have it. There you have
And
it.
listen, the key word he used before he went to the chart was you got to have patience.
Patience.
Got to have patience. You can't rush in. You can't rush out either. Can't rush in or rush out. Now, of course, you got to understand, again, what amount of money you are willing to lose before you get out, and then what amount of money you're willing to make as well. And I guess I'm not the expert here always, but I'm putting my little 2 cents in. All right, you got to know how much. You got to say, okay, if I'm going to put this in, how much am I willing to lose, and then know how much. And if you don't know how much and you're not sure what to do, that's when an O package comes in to help you figure out how much money do I need to put in, how much am I willing to lose before I get out, how long do I want to stay in. These are all things you need to learn to know how to do when you start doing your stocks and your trades, or if you're day trading. There's all kind of terms out there I'm not going to go through because I'm not the guy to give it. But I do what I do. And, like I said, I got my O package. You need to get yours. So some unconventional things being done. And there's some things he does that are just pretty much general across the board.
Yeah,
there's some things that he is doing that are unconventional that he is definitely the man you want to talk to. So any last words before we end out, brother?
Yeah, man. Look, what I gave tonight, you could take just that alone and change your family's life.
For sure.
You tell the kids when to get out, when to get back in, and load the boat. You can take $10,000, buy when it's going up, get out when it crosses that line, and get back in when it crosses the other line with what you made. You'll change your family's life. It takes time.
But again,
that's not even that. Like it's and you're not checking it it's literally a week of it's a week of waiting for a bar to close. So like, just for my last example, it's when you got back in again was May 2020, and you still be in it in December 21. So that you're not even, you know what I mean? You're not even really, you're chilling, making all that money. Again, I know I'm making it sound simple, but you saw the chart. I didn't draw those lines.
And the market's going to do what the market's going to do.
The market's going to do what it's going to do. So it again, even if you don't, I wish somebody, like, I wish people see it, because even if you don't get the O package, you literally could take that plan and change your whole 401k around. Like, you don't got to deal with the crashes.
Yeah.
How about that?
And real quick, there was a guy, I don't know his name, I can't remember who he was. He took one trading chart and replaced his income with it, and is now a millionaire.
There you go.
One trading chart. That's it.
And like I said, I ain't there yet, but we getting there. It's
right.
Like I said, again, we got the tools to build the house. So just gotta build the house.
There you go.
I'm working on the basement right now. I'm about to start putting in the hoses now. Putting in the line.
There you go. Starts with one brick, one layer, one
brick,
wall.
Man. Yeah.
So thanks again. Oh, we appreciate you, man. This is the last stock trade and investment podcast we're doing for this year, 2021. We will resume our stock trade and investment talks in February of 2022. January, we're going to take that time off, do some different things before we go into February. So the first week in February, we're doing our stock trade and investment talks, and you never know what O's going to come up with. So make sure you stay online, and then go back, and whether it's via a video or in the audio podcast, and check out the first 4 we've done leading up to this, and see what you can do right now to start making money and building wealth for your family, because everybody can do it. It's just a matter of getting started. You don't have to have $1,000, he said before. You ain't got to have 100. You can start with $50. Sometimes maybe less than that.
I'm gonna say one last thing and I'll be done.
You got it.
If you got a big family, take this strategy tonight and put money together. And y'all attack the market together with that strategy. You could change everything. I'm telling you now, but I'll leave it at that. I said it. It's December 1st, 2021. Remember when I said it?
There you go. And I ain't going to say anything else after that. So thanks for joining us, guys. It's been another great stock, trade, and investment podcast with my man O.
Yeah.
And again, you can contact the show here at FOFM podcast at frameofmindinc.com. That's FOFM podcast at frameofmindinc.com, or give us a call at 302-689-3499. Again, that's 302-689-3499. Excuse me. So join us again next week. We'll have another great podcast for you guys, and then we're going to look to start ending out the year before we head into 2022. And thanks again for joining us. And as always, continue to think it, speak it, and achieve it. And until next time, holla. Thank you for joining the Frame of Mind Inc. podcast. And as always, here at Frame of Mind Inc., think positive thoughts, say positive things, and do positive deeds. As our tagline says, think it, speak it, achieve it. See you next time.
It's a frame of mind. It's what you say and what you do.
Don't forget to check us out on the web at www.frameofmindinc.com, where you can browse our online apparel store, listen to some of our original music and production services, as well as view our videos and projects we've done for our clients and customers.